Welcome to The Explainer. Today, we're doing something a little bit crazy. We are taking a rigorous, absolutely uncompromising value investing framework and, well, slamming it straight into a clinical stage biotech company to see what happens. I'll be stepping into the shoes of a senior fundamental equity analyst today, and we're going to stress test Immunome Inc., ticker symbol IMNM. Let's find out if traditional financial gravity even applies to scientific innovation, right?
Okay, let's fly through our analytical blueprint real quick. We've got 6 steps today. Baseline extraction, mode assessment, running 6 valuation models, checking off Warren Buffett, then Peter Lynch, and finally bringing it all together for the final verdict.
All right, step 0, baseline extraction. We need to confirm the financial reality of IMNM. So before we run any fancy analysis, we've got to pull the raw, unvarnished data straight from Immunome's SEC filings. And man, the immediate tension here is wild. You're looking at a company with a massive $2.35 billion market cap, but they have exactly $0 in Q1 revenue. None. Zilch. They posted a net loss of over $212 million last year and deeply negative free cash flow. Yet, and here's the kicker, they're sitting on a mountain of cash, over $582 million. It's literally the ultimate fundamental paradox.
Moving on to step 1, business overview and moat assessment. We are searching for an economic moat. To score their competitive advantage properly, we actually have to understand what they do. And well, Immunome doesn't sell a product yet. They're a clinical stage targeted oncology company. Basically, they're burning through cash to advance highly complex cancer therapies, most notably their phase 3 drug, varegacestat. Their future customers will be patients and healthcare providers. But right now, their biggest risk is just straight-up clinical trial failure, or FDA rejection. If that happens, it could practically wipe out their entire value within the next 5 years.
So when we run our strict 0 to 2-point moat scoring system, it's pretty brutal. Network effects? 0. Switching costs? 0 because there's no commercial product yet. Cost advantage? 0. Efficient scale and toll road? Both 0. We literally can only scrape together a single point, a narrow one for intangible assets, thanks to their patents and clinical progress. So our overall moat verdict here is unequivocally none.
Okay, step 2, 6 valuation models. I like to call this the math collision.
This is where traditional Wall Street math violently collides with a high-growth, zero-revenue biotech. Our first model is the gold standard, the discounted cash flow, or DCF. To find intrinsic value here, we absolutely need historical free cash flow, revenue growth assumptions, margins, and a discount rate. But as you'll see, Immunome breaks this formula literally on day 1.
You simply cannot run a meaningful DCF analysis on a company bleeding $200.6 million in free cash flow with 0 revenue coming in the door. Any growth rate assumption you try to apply to a deeply negative base just gives you an even deeper negative intrinsic value. So model 1, total failure here.
All right, model 2 is the Benjamin Graham number. This is a classic value investing staple, right? It calculates a fair price by taking the square root of 22.5 times earnings per share times book value per share. Well, Immunome has a trailing earnings per share of negative $2.43. The math literally breaks. You cannot calculate the square root of a negative number. The Graham model just throws up a massive error code.
And this brilliantly highlights why models 3 and 4, our relative valuation models like enterprise value to EBITDA and price to earnings, also fail spectacularly here. To get an implied price, you need positive earnings or EBITDA to multiply against an industry average. With an EBITDA of negative $221.6 million, comparing it to peers just confirms what we already know. They are burning cash.
For model 5, the dividend discount model, we can confidently just slap a not applicable on this one. They pay exactly 0 dividends, so there are absolutely no future dividends to discount back to the present. Moving on. Finally, model 6, earnings power value. This one calculates a strict no-growth floor value based on normalized EBIT. But since Immunome's normalized EBIT is deeply negative, their so-called no-growth floor is effectively 0, or theoretically negative. So let's look at the final tally. It's a total breakdown of traditional financial modeling. Intrinsic value is negative or non-applicable across the entire board. If we were forced to weight these models, our intrinsic value would literally be 0. Our confidence in these traditional models for pricing this specific type of clinical stage company? Absolute 0.
Let's pivot to steps 3 and 4, the checklists. Time for a qualitative assessment. Having barely survived that mathematical collision, let's look at the rigorous qualitative checklists of Warren Buffett and Peter Lynch, starting with the Oracle of Omaha himself. Immunome fails nearly every single criterion. Consistent earnings? Fail. High return on equity? Fail. It's negative 33.5%. Positive owner earnings? Fail. Simple, understandable business? Far from it. They're developing complex oncology ADCs. Margin of safety? Huge fail. The strict Buffett verdict here would be an undeniable run for the hills avoid.
However, Immunome does actually secure one massive pass for Buffett, and it's absolutely crucial: incredibly low debt. They have a microscopic debt-to-equity ratio of 0.08, they are carrying practically zero long-term debt, and as we saw earlier, have over $580 million in cash to fund operations. So they are highly, highly liquid.
Now, let's apply the Peter Lynch checklist, which tends to be a little more forgiving for unique situations. They fail his PEG ratio test, obviously, because they have zero earnings. But Lynch categorized stocks, and Immunome actually partially fits his profile of an asset play or a highly speculative fast grower. But honestly, the most fascinating metric on his checklist is institutional ownership.
Peter Lynch loved stocks that Wall Street hadn't completely crowded into yet. He wanted institutional ownership below 50% to leave room for discovery. Well, Immunome sits right in the sweet spot at 44.58%. Over the last 12 months alone, major institutions have quietly poured $524 million into this stock. The smart money is buying in heavily, but they haven't breached that 50% threshold yet.
All right, time for the final verdict. Let's reconcile this massive dissonance.
So the first 4 steps of our framework generated a massive pile of not applicables and fails. How on earth do we reconcile this strict fundamental verdict with a company actively trading at a $2 billion valuation? Well, here is the reality check. Traditional value investing frameworks are built to measure present, predictable cash flows. If a company doesn't generate cash, a DCF model simply says it's worthless. But the biotech market reality is a totally different beast. The market is pricing Immunome strictly on the probability of future binary clinical outcomes. It's a calculated gamble on science, not a spreadsheet of past profits.
The market is looking right past that negative cash flow and focusing entirely on the catalysts. They have a $582 million cash runway that funds them all the way into 2028. They've submitted a new drug application for varegacestat. They've got highly anticipated phase 3 data coming up, and they're rapidly advancing a whole pipeline of targeted oncology drugs. That is what that $2 billion market cap actually represents, the statistical value of hope and future medical breakthroughs.
Which leaves us with a final, really provocative thought to chew on. If our most rigorous, battle-tested financial models declare a company like Immunome totally worthless today, does traditional value investing simply not work for clinical-stage biotech? Or worse, by demanding immediate profits, do these models completely miss the point of funding world-changing scientific innovation? Definitely something to think about the next time you're staring at a balance sheet. Thanks for joining me on this explainer.